So, note 2. Marchant disposed of an 8% equity in Nathan on 30th April 2014 for a cash consideration of 8% and had accounted for the gain or loss in other income. The carrying value of net assets of Nathan at 30th April 2014 was 120 million before any adjustment on consolidation. Marchant accounts for investment in subsidiary using IFRS 9 financial instruments and had made an election to show gains and losses in other comprehensive income. Now you got to understand that there is a contradiction here. First, the company has sold 8% of their investment and they have accounted for it in other income from the first session. But the second aspect of the question is saying that the company accounts for its investment using financial instruments and has decided to show any gain or loss in other comprehensive income. What does that mean? It means we need to calculate the gain or loss on the disposal. So to do that, we sold the 8% for 18 million. But we own a total of 60% of the company. And we are told that as at the date of acquisition, the value of our investment, as at the date of disposal, the value of our investment was 95 million. So our 60% investment represents 95 million. So 8% will be what? So to do that, we'll do 8% of 60 times the 95 million, and when we strike it out, we get 5.3. But this gain on disposal, we are told with the first aspect, the second line of the question, that it has been included in other income. So when we go to consolidated statement of profit or loss, we will subtract this 5.3 from the other income. But in addition to doing the disposal in Nathan, we have seen that from 2013 to 2014, there has been a gain on the investment. And so it is 95 minus 90, and that gives us 5 million. So this is how we treat or account for that transaction there. So note 3. So let's go together now. Marchant acquired 60% of the equity interests of Option, a public limited company, on 30th April 2012. Okay. So what is happening? So let me claim this. It means my group structure will be adopted, right? Now, it won't be a linear group structure any longer. Because it is not Nathan acquiring. Who is doing the acquisition? Marchant doing the acquisition. So we can still put Option here. But this time around, it should come from here. How many percentage? 60%. Meaning NCI in Option is also what? 40%. But we have to be careful the date that it was acquired. What was the date of acquisition? Date of acquisition? 30th April 2012. Alright. So you see that I left this place blank. So I'm going to do Options goodwill here. How much did we pay? So let's go. The purchase consideration was cash of 70 million. Options identifiable net assets were fair valued at 86 million, and the NCI had a fair value of 26 million at that date. At that date. So I want to deal with that aspect before I come to the second aspect of the question. So let's go. Goodwill in Option. So percentage Option. We acquired 60%. How much did we pay? 70 million. NCI 40%. What was the fair value? NCI value
28 million.
28 million. We add the 2, it gives us 98. Net assets, fair value of net assets at acquisition was what? 86. We subtract. What will be the goodwill? 12. Good. So that is a goodwill in Option. That is a goodwill in Option. So that is the first part of the question. The reason why I separated that is because the first part of the question is different from the second part of the question. And when you are reading the question, that is why you need to follow the strategy I am following when I'm solving the question. I try to chew it bit by bit. And yes, I will read it, you will be overwhelmed. Into read it, do baby. Then you see that the second aspect is going to be something different. Treat that before you come. On 1st November 2013, Marchant disposed of 40% of equity interest in option for a consideration of 50 million. For a consideration of 50 million. Options identifiable net assets were 90 million and the value of NCI was 34 million at the date of disposal. The remaining equity interest was fair valued at 40 million. After the disposal, Marchant exerts significant influence. Any increase in net assets since acquisition has been reported in profit or loss, and the carrying value of investment in option had not been charged since acquisition. Goodwill had been impaired, tested, and no impairment was required. No entry has been made in the financial statement of Marchant for this transaction and other cash received. Nice one. So let's see. So the second part of the question is about disposal of what? A subsidiary. Why? Because we own 60% and we are selling how many percent? 40%, meaning we are losing control. The calculation of gain or loss on this disposal will be different from when we are selling just part of our investment and we are still having control. So I want you to get a picture as well. So what do we do here? The way we go about it, so disposal of option. Step 4, or not working for. Disposal of 40% in option. So this is change in ownership. Change in ownership. Now, so we go. To look at this, we are going to bring the fair value of the consideration we received. We are going to bring the NCI value that is also there. Then we are also going to bring the rest of our investment that is there. So fair value of consideration received. How much did we receive? Fair value of consideration received. 70 million. Then, what is the fair value of NCI? The fair value of consideration received. Disposal. 50. What is the fair value of NCI? 34. Now, listen carefully. The fair value of this consideration is actually 40%. But we are still left with a 20% ownership. That 20% ownership is how much? Are you sure it will be 34? 40. Yes, we will treat it as an associate. And that is what? 40. Now listen carefully. Why are we doing this? Number 1. This is how much money we are receiving. Number 2. This is the value of our investment right now. It is all ours. Number 3. We are losing control. So any value of NCI will come to us. So we sum these 3 guys up. What do I get? 124. Then look at what is going to happen. Since we are losing control, it means any goodwill on it will no more be in our books. So this is the total value of the disposal. We're going to be lessing their net assets as at the disposal. What was the net asset at disposal? Net asset at disposal. 86. You sure about that? Options identifiable net asset were? No. Options identifiable net asset were 90 million. Can you see that? The 86 is the first part of the question. Yeah, goodwill. You are still looking at the first part of the question when we are on the second part of the question. Derek, have you seen what I'm saying?
Yeah, but why do you leave that?
Why do they do that? No, you don't have to be confused. You just have to look at how the build-up is. How the build-up is. So net assets on the second part is 90. Is it 90? 90. Then we bring goodwill because that goodwill will no more be there. This 12. So we add the 2. That will be 102. After the other candle, that will tell us this is the gain on the disposal. And what do we get? 22. Any question? This is how we account for loss in control. And it is different from when we are just selling parts of our investment and we still having control. Okay, so please write and let me soup up my board and let's continue. But before then, please stay with me for the final aspect of this workings. Shadie. What is now our investment in option? Our investment in option now will be what? 20%, which will be valued at how much? 40 million. Now we will account for this investment using the equity method as per IAS 28. When was the disposal made? 1st November. And I want you to take dates into consideration. So the disposal was made on 1st November 2013. But what is the year ended under consideration? 30th April 2014. What does that mean? Now, I'm coming to make a bomb statement here. You have to get it wrong. 1. It means when we are doing consolidation, the profit or loss account, we will take 6 months of options figures. Because we acquired them for only 6 months and after that we lost the control. So their performance for the year, we will only add 6 months, half, when we are doing consolidated profit or loss accounts. Number 2, the second half of the 6 months, our investment will be carried at what? Using the equity method. And so we will earn an interest on their investment. So if you go to the financial statement, how much money did they make? How much money did they make during the year? Profit for the year. They made 15. So of that 15, we will take what? 20%, but it is only what? 6 months. So share of profit from associate. And that associate here is option. Will be 20% of 15 million of 6/12. Maybe I'll show what you are saying. Can you punch for me? And this will go under the parents. That is Marchant's account as share of profit. It's 20%. 1.5 million. So this 1.5 million will go on the face of the profit or loss account for Marchant Group as share of profit from the associates. But you got to take it gradually and chew it one after the other. That is why I'm shooting the videos, so that you can re-watch, replay, and it will help you to go through it properly. So note 4. Note 4 is under intergroup trading. I read the question carefully. Marchant sold goods to Nathan for $12 million at fair value. At fair value. At fair value. Merchant made a loss on the transaction of $2 million, and Nathan still holds $8 million in inventory at the year end. Okay. What is the rule for intergroup trading? We need to eliminate the sales, isn't it? So in the elimination of the sales, we're going to be debiting the revenue to cancel the whole figure of what? 12 mil. And we'll credit what? The cost of sales. With 12 mil. So we reduce inventory with 12, we reduce cost of sales with 12. Nemo TNE or say merchant made a loss of 2 million. Do we account for this loss? And how would we account for it if we are supposed to account for it? Yes?
The 2 million loss relates to the whole 12 million sale.
Right.
So we have to, it means we have to reduce the 2 million to match up with the one left in the inventory.
We have to reduce the 2 million to match up.
So the loss, the 2 million loss is equal to 12 million sales. So if 12 million sales is 2 million loss, what is 8 million? What am I saying?
Thank God you are seeing yourself. Yes, what do you think we have to do?
What I'm trying to say.
No idea.
We will not account
We will not account
for it.
for it. Why?
Because it's intergroup trading.
So, but then if it's a group trading, provision for realized profit, don't we account for it?
We are going to do that to the 8 million, the one that is left. The 8 million inventory
Left.
yes.
So,
That is where we are
so then what? How do we now account for that loss? Because if some is left, that means the loss recognized should be reduced. I don't know if you get a picture. Now, this is, you see there is an idea of provision for unrealized loss. This one is not profit, it's loss. But we won't account for anything like that here. Why? Because the sales was made at fair value. The sales was made at fair value, meaning that inventory may have been paid during the year, so we don't do anything to the loss. This is the only thing we account for.
Why?
Because the sales was made at fair value.
So what have we made it at fair value and you made a profit?
Still, we won't account for it.
So when it's fair value,
When it's at fair value, we don't account for it. Because when inventories are sold at fair value, up until the end of the year, they may have suffered some impairments by themselves already. So we don't do anything to it.
Fair value is the price. So if we bought it at a certain price, and we sell it at a certain price, and we make a loss.
We are making a loss. Now, if you are going to account for this loss, that means you are going to reduce inventory, isn't it? Isn't it? You are going to reduce inventory. But the thing was sold at fair value. If it was sold at fair value and you made a loss when you were selling it, doesn't it inform you that even as at the time you are reporting, the inventory has also fallen in fair value? I don't know if you understand what I'm saying. The idea is this. The sales was made at fair value and you made a loss. But as at the end of the year, it means inventory will still be carried at what? Fair value. So some way, inventory will suffer some level of what? Impairment. So this loss, we don't account for it again as a further loss to the inventory. That is why we won't do anything to it. The only thing we do here is to reduce sales and reduce cost of sales. So I want you to get the reason behind what we are doing. Yeah. So profit or loss account, we subtract this from sales, we subtract that from cost of sales to reduce it. So that's note.
fair value won't be able to.
Yes.
So we said merchant sold inventory to Nathan for 2 million or 12 million. they did not add a fair value.
Okay.
They went on to bring in the loss. They would have accounted for
We would have accounted for it as it will be accounted for. So let's go. Note 5. Note 5 is on IAS 8. That is employment benefits. So IAS 19 rather, employment benefits. You remember what we did at the employment benefit, eh? Samukai. The following information relates to Marchant's pension scheme. We have the plan asset at start 2013. Then we have the defined benefit obligation at start at that figure. Then we have service cost for the year ended. Then we have the discount rate for the year. Then we have remeasurement loss in the year ended. Then we have past service cost. The pension costs have not been accounted for in total comprehensive income. So how do we account for it now? How do we account for it now? 1. We're going to bring the current service cost. What's the current service cost? 4 million. You see that? Then look at it. If you remember what we did under IAS 19, we calculated the profits on what? The assets, returns rather, returns on the asset, and we calculated finance costs on the liability. Do you remember that? So we are going to take the net benefit here. So we will strike the difference between the two. So net interest will be the asset. Okay, so the obligation is, so it's going to be 10% of how much? 50 million minus what? 48 million. What do I have? 10% of 50 million minus 48 million. And this is a defined benefit, so very important. No 0.2. No 0.2. So we bring the current service cost, we calculate the net interest between the obligation and the asset, add it up, then we bring the past service cost. What is the past service cost in the question? 3 million. Add it up for me, what do I have? 7.2. Then we are told that remeasurement loss in the year ended 30th April 2014 is 2 million. What do you think is that remeasurement loss? What do you think is that remeasurement loss? It is like the actuarial gain. Or sorry, actuarial what? Loss. So we're going to add that to it, remeasurement. Of 2 million. So the total is going to be 9.2 million. 9.2 million. So this will be taken to the income statement. The 7.2 will be taken to the income statement, and then the remeasurement loss will be taken to other comprehensive income. So that is what we do in relation. So the 7 million, that is the net service cost, will go to income statement. Then the remeasurement will go to other comprehensive income.
But you see, when we were working the IAS
Yeah, so we did the assets component and we did the liability component.
Yeah.
Yes, we have just taken a net of it here. Because we are not supposed to even do balance sheet in this question. It's just income statement. That's why we will take the net effect of the assets and the liability and bring the issues. Because if you remember there, you remember that the current service cost was being brought. Right? Was being brought. And then the past cost will bring. The reason why we are adding past cost and we are not